Hey Bowtie Nation, Joseph Hogue here with a new series on the channel and one of the most popular themes, monthly dividend stocks. Every couple of weeks I'll be digging into the Nareit REIT Watch report of real estate dividend stocks, as well as the Raymond James Weekly Insight report on those high-yield business development corporations, the BDCs. These two reports offer loads of information on some of the best dividend stocks around, the highest yields, and most of them monthly payers. In fact, there's almost too much information to digest, so we're going to cover just one topic each video, and this week I'm going to show you the 10 highest yielding monthly dividend stocks in these lists. We'll work through the analysis, find the highest yields, but more importantly, the highest sustainable dividend yields, because if you've been investing in dividends long enough, you know that sometimes those with the absolute highest dividends aren't the best stocks, especially when they cut that dividend. Let's get started. I'll show you how to find each of these reports and some of the information in them. Understand, I have no relationship with either of these two companies. I don't get a commission or a kickback if you use the reports. I follow these reports, it's some great analysis, and I want you to have the best resources when you invest. Another important resource you'll want to see is our free weekly newsletter, the Weekly Bowtie, with all the stock market news, strategies, and trends you need to see. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link in the description below. We'll start with the 5 highest yielding REITs, but stick around because those BDCs pay even higher dividends on average. To find the REIT report, you can search Google for Nareit, that's N-A-R-E-I-T, that's the National Association of REITs, where you'll find a lot of other data on stocks in the group. Now remember, real estate investment trusts are just companies that buy property and collect that monthly rent. Both of these REITs and BDCs are special types of companies that get a tax break if they pass on almost all their profits to investors. They pay no corporate income tax, so these are some of the most efficient business structures to hold those cash flowing assets. And the result is those higher dividend yields versus regular stocks. Back to the Nareit, and we'll go here to REIT data in the top menu and then REIT market data in the dropdown. You can check out these other reports, and I recommend you do if you really want to get into real estate investing, but we're going to focus on this monthly REIT Watch report. This is a huge report. You can see here it's 51 pages this month, but I'm going to walk you through the most important information to help you find the analysis that you need for those best monthly dividends. The first data here you're going to see is overall REIT returns, but I'm more interested in the individual property type returns. You know, they say all real estate is local. Well, commercial real estate is all about the property type, the demand for it right now, supply, and other economic factors. So I always start my REIT investing by selecting 2 or 3 property types I think can do really well over the next year, and then picking the individual stocks within those, which we'll look at next. Here you can see the real estate sector had a decent 2023 with an 11% return, but has given back 2% of that so far this year, and all this is after a disastrous 2022 when the group fell 25% on the Fed's interest rate increases. With the Fed getting ready to reverse course on rates and a lot of the other factors turning, I think 2025 could be a very good year for real estate in general, but again, you want to pick out the few of the property types on which to focus. And here are the 16 REITs I pulled out for our list. I'll highlight my top 5 dividend stocks from the list, but you can see I also pulled out information on FFO growth, the payout ratio, and the company's debt to EBITDA, or just a basic debt leverage. A high dividend yield is great, but if the FFO isn't growing, then the company won't be able to increase that payout and may eventually have to cut it. So we also want to see the highest FFO growth possible here. The FFO payout ratio is the percentage of those funds from operations, so that cash flow that's going to meet that dividend amount. Now obviously a company can't pay out more cash flow than it generates, so anything over 100% here is a big warning sign, but even the higher ones into the 80s and 90s could mean slower dividend growth or that danger of a cut, so we're looking for the lowest payout ratios here. Now, real estate companies always use a lot of debt. It's just how the industry is run, but there is a limit. Debt that gets too high is a big problem when rates do rise, and also just means more interest that they have to pay out. It's going to put pressure on that dividend payment. So I sorted the table by each column, then highlighted the best 5 for each statistic in yellow, and then the 5 next best in blue. Then I resorted on dividend yield so we could see how our highest yielding stocks worked out, and you can see here it's not just a matter of picking the very highest dividends. I do like some of these highest yielding stocks, as I'll highlight next, but they aren't without their risks as well. While Service Property Trust offers the highest yield here and one of the best 5 for low payout ratio, the FFO is shrinking and it's got one of the highest debt burdens on the list. That low payout ratio probably sustains the dividend for another year or even longer with that negative FFO growth, but beyond that, you have to start getting worried. Here's something like Global Net Lease, though, may look tempting with its 15% dividend, but almost no FFO growth and already paying out 173% of its funds from operations to cover that dividend. That means a cut is very likely at this point. I'll highlight my top 5 here, but more analysis needs to be done before buying into these stocks. Look into these companies. If they are seeing falling stock prices, then you need to understand why some investors are selling, and if you want to take a chance or just go with another stock with maybe a lower dividend but better fundamentals. For my top 5 highest dividend stocks in the REIT space, we'll start with Gaming and Leisure Properties, ticker GLPI, which only pays a 6.7% yield, but has some great fundamentals and is seeing a strong trend in its industry. The company owns 52 properties in 17 states, many without a competitor for more than 60 miles. Its casinos are operated by some of the biggest names like Caesar, Boyd, and Penn National, with over 15,000 hotel rooms. Besides the growth in gambling that we're just starting to see across all the US, I really like the company's strategy here. It contracts with operators on a triple net basis, so the casinos pay all costs, including maintenance. Strong contract terms means GLPI has been able to keep 100% occupancy since its inception. Now, the FFO growth didn't make the top 10, but is high enough to grow that dividend, and both the payout ratio and debt leverage look really good here. Innovative Industrial, ticker IIPR, also makes the list with its 7% dividend and a potential workaround to recent problems with its tenants. IIPR is unique among real estate investment trusts or REITs in that it leases to companies in the regulated cannabis industry. The company has stepped up to meet the industry's limited bank funding to supply real estate for grow and retail operations. IIPR owns 111 properties with 30 tenants across 19 states, and while the cannabis-related stocks have fallen hard over the last few years, I consider IIPR more of a real estate play than marijuana. The industrial and retail properties owned by the company can also be reworked to serve other industries, so for that reason the shares have done well. The FFO growth at 3.8% puts it in the top 10, and though the payout ratio is a worry, company is the lowest levered in the group, so very low debt burden here, and worst case scenario, I think the company could probably sell a lot of its assets to higher levered companies, get a good price for its properties. Outfront Realty, ticker OUT, gets us an 8.4% dividend and is one of the largest owners of outdoor billboard, transit, and mobile real estate in the United States. This FFO growth surprised me here at 8%, one of the top 5 in the group, because you wouldn't think that outdoor billboard advertising is a growth market, but that combined with the low payout ratio puts it on the top of our list. Our last 2 REITs here are the problem children of the group, but I think worth the risk. First is Medical Properties Trust, ticker MPW, and it's almost 14% dividend yield. MPW is the second largest owner of hospitals in the world with 442 properties and a rare international exposure for a REIT, operating in 34 US states and 9 countries. It's about 60% of the portfolio in the US, but also 22% in the UK and throughout Europe. Of course, MPW has struggled recently with a tenant bankruptcy, along with a crisis in hospital operations for all of its tenants, but this is one of my big turnaround plays for 2025. We're just starting to see healthier financials for hospitals, which should flow through down to better rent collection for MPW, and lower interest rates should prop up real estates in general. Now, these stats are pretty ugly for MPW, with negative FFO growth, an unsustainable payout ratio, and the highest debt leverage in real estate, but that's all priced into the stock at this point. Shares are trading for a price of just 5 times FFO, compared to an average closer to twice that for other healthcare REITs, so any improvement is going to see this stock jump. And Service Properties Trust, ticker SVC, is probably the riskiest of the group, but offers that 15.6% dividend for those willing to take the risk. The company operates in the hotel leisure segment as well as retail properties, and again, while that FFO growth and debt leverage is a dangerous sign, the lower payout ratio probably gives the company time before the dividend is in jeopardy. Now, this one needs more research, but it could be a good turnaround play along with that dividend. Now on to our BDC report. You can find this by searching for Raymond James Weekly BDC or BDC Weekly Insight, and the most recent issue is usually going to be the first result. Just make sure the date remains within the 7 days. Remember, BDCs or business development corporations are like investment banks for small and mid-sized companies. Those really big enough that they need more than that's what's available from a regional bank, but still too small to get any love from the stock market IPOs. So these BDCs issue loans, but also take a small equity stake in their portfolio companies, and again, get that special tax break if they pass on almost all profits to investors. The dividends are even higher here, typically in the double-digit yields, with almost all of these BDCs paying monthly dividends. This is another big report, so don't feel like you need to read all of it, or all in one sitting. So putting our list together, I first went to that total dividend yield rankings and noted the BDCs with yields over 13%, which gave me 16 names. I then went to the rankings for weighted average yield and return on equity, looked for each of those 16 stocks, and then noted the data in our spreadsheet. And this isn't all the data that you want to look at when you're analyzing your own BDCs, but it's two of the most important, so a great place to start. For this weighted average yield, remember, that's the average interest rate the company collects on its portfolio of loans. Ideally, you want that rate higher than the dividend yield because the company collecting higher interest can obviously support its dividend or even grow that payment. I've added another column here, that yield spread between the weighted average yield and the stock's dividend yield. Then I sorted the stocks by highest spread, so those collecting higher portfolio interest versus what they're paying out as dividend yields, and highlighted the top 5 in yellow. We see here most of these, the very high yield stocks, they pay a higher dividend yield than they're collecting from their portfolio loans, so that is not great, but it can be done if they're using leverage. I also noted the return on equity for each stock. That's a core measure of return, how well management is using the owner's or investor's equity in the company to generate those profits. Again here, I sorted by highest ROE and then noted the top 5, then resorted the list by highest total dividends to see how those highest yielding stocks stack up against the other two measures. And I'll show you my picks for the best monthly dividend stocks among these BDCs next, the ones with not just the highest yields, but also the best fundamentals. But don't miss this video next for the one monthly dividend stock every investor needs in their portfolio. If you buy just one monthly dividend payer, make it this one. First on our list, Prospect Capital, ticker PSEC, with its 14.7% dividend. And while that's quite a bit below the portfolio yield it collects, this one has produced a good total return for a while and is one of the larger BDCs. The company manages a $5.7 billion portfolio of 122 investments in companies across 36 industries and earns a 12.1% yield on its portfolio. That's quite a bit below that dividend yield again, but the company has been able to manage it and keep that dividend over the last 5 years. Still though, the stock price has suffered, and I wouldn't rule out a cut, so this is probably my least favorite of my 5 BDC stocks. Still though, Prospect has been able to pay out nearly $21 per share in dividends, more than $4.2 billion since its IPO, and if you're only focused on that dividend cash flow, you might take another look at this one. Next up, Trinity Capital, ticker TRIN, and while it does pay a lower 14.1% dividend yield, the fundamentals here are much better. You can see that not only is the return on equity one of the 5 highest, but it also has the highest spread between its interest it collects on its portfolio loans and the dividend yield. It's a very good sign for dividend sustainability. For these very high-yielding stocks, that dividend sustainability is everything because, hell, if the shares can keep on paying that 14% yield, then you really don't have to worry much about the stock price. Oxford Square Capital, ticker OXSQ, pays the same yield at 14.1%, but has produced a higher return on equity, in fact, the highest of the group at 19.3%, so that puts us a little higher on the list, even though it's a slightly negative on its yield spread. That ROE, though, will help to not only just support the dividend, also the stock price as well. Down to the top 2 monthly dividend stocks with BlackRock TCP, ticker TCPC, and its 14.9% dividend. While the yield spread is a deeper negative here than the others, with only a 13.7% portfolio yield, that high ROE should support the stock. And my pick for the best high-yield dividend here is Triple Point Venture Growth, ticker TPVG, not only for its 16.1% dividend, but for the second highest ROE of the group and an average portfolio yield that comes very close to covering its dividend. Like most of these, the stock price has trended down, but including that dividend cash flow has yielded a good total return, so check this one out. Get all the stock market news, trends, and strategies you need to see every week before the market opens with the Weekly Bowtie, our free weekly newsletter with the link in the description, or click on the video to the right for the one monthly dividend stock every investor needs to buy. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.